bro, you must help me, okay? But don't tell my wife. I took our life savings, right, and bought Facebook stock. And guess what? Tomorrow's earnings, if the stock tank, I'm going to lose my wife. You have any help or not? Please.
Have you ever been put in a situation where earnings of a stock that you are so heavily committed to is coming and you are so scared that the worst case scenario may happen and the stock were to nosedive? If so, then continue watching as I will be sharing all you need to know about buying a put option. Anyway, Darren here. I've been trading and investing in options since 2008 and I would like to use YouTube as a platform to share how options work, various option trading strategies, and trade execution videos. Before I start, the usual disclaimers: this video is not meant as financial advice. Options are definitely risky, so if you are new to options, do yourself a favor, okay? Research and paper trade first before putting real money to trade. These will be my agenda for this video. What exactly are put options? How a put option works? How to calculate the break-even of your put option trade? I'll then talk about what it means for a put option to be in the money, at the money, and out of the money. Advantages and disadvantages of buying a put option, a way to stack the odds in your favor, and I'll end with my trade reflections from my Facebook Leaps call that could have been saved had I bought a put. Before I begin, YouTube has actually highlighted that most of you guys come here to watch my videos but do not subscribe to them. So I'm going to give you some time, scroll down, find that like button, do me a favor and click on it. And while you are clicking the like button, smash that subscribe button for good luck in the stock market. Now, let's get on to the video. A put option is a contract that gives the option buyer the right but not the obligation to sell 100 shares at a predetermined price known as a strike price on or before a predetermined date, also known as the option expiration date. Let me elaborate on this further. Let's meet Alan. Alan has been doing his research and he has come to the conclusion that Boeing is going to tank within the next few days. What Alan can do is go to the option market and buy a put option on Boeing. Let's say he were to buy a put option that expires on the 18th of March 2022 with 39 days till expiration. If we were to look at the option chain over here, the asking price for a strike of $210 would cost him $970. Now, how did we get $970? Remember that one option contract controls 100 shares. Hence, when we were to buy a put contract, we would look at the price the market is asking, and that would be $9.70, and then we will multiply that by 100, which would give us $970. Let's go through the various scenarios that might happen. Scenario number 1. Let us assume Alan's prediction of Boeing was spot on and the stock drops to $150. As this is below his put strike of $210 at expiration, hence Alan would be able to buy 100 Boeing shares at a market price of $150, knowing with certainty that he can exercise his put option to sell 100 Boeing shares at that predetermined strike price of $210. His profit in this scenario will be $210 minus $150 times 100 and minus the premiums that he had paid for the contract, which in this case would be $970. Therefore, Alan would have profited a total of $5,030. Okay, I'm going to give you guys some time to take this all in. Scenario number 2. Let us now assume that Boeing, instead of tanking, were to remain above $210 at the expiration date of 18th of March 2022. For this scenario, let's say that Boeing is trading at $220. In this instance, Alan would not exercise his put option and the option will expire worthless. Wow, Darren, why is this so? Hey, chillax friend. So let us go through this scenario to get a better understanding. You see, Alan's put contract only allows him to sell 100 Boeing shares at $210. However, no rational person will buy 100 shares in the open market for $220 and sell them for an instant loss of $10 per share. It would not make financial sense at all. Therefore, Alan would not exercise his put option and his loss would be the option premium of this put contract. At this point, I'm sure some of you guys may be wondering if Alan has to hold the put options to maturity. And the answer to this question is no. You can buy and sell your option contracts to the market anytime you want. Let us now calculate Alan's break-even. As he has paid $9.70 for the option contract, therefore, his break-even for this position would be his strike, which is $210, minus $9.70, which equals to $230. I personally feel that we should always calculate our break-even whenever we buy an option contract so that we can have that price target to aim towards. At this point, it is also worth mentioning that a put contract can be either in the money, at the money, or out of the money. A put option is said to be in the money if its strike price is more than the current trading price of the stock. A put option is out of the money when the strike price of the contract is less than the current trading price of the stock. And a put option is at the money when the strike price is equals to the current trading price of the stock. Let us now go through the advantages of buying a put. So most of the time, people buy puts purely for trading at speculative purposes. Perhaps they feel that a stock is going to tank and they want to profit from it. Therefore, what they can do is buy a put, and should the stock tank, the premiums of the put contract should go up. However, you may be asking, why not just short the stock? For that, we need to understand that when we buy a put option, the maximum that we can lose is just the option premium. Hence, in the event the stock goes the opposite direction, our losses are capped. Let us contrast this to shorting a stock. You see, when we short the stock, we are selling the stock first and buying it back at a later stage. But what if the stock goes against you and rallies all the way to the moon? Then you'll be forced to buy that stock at whatever price the market has to offer. Hence, shorting the stock can result in an unlimited losses. Let's take a look at GameStop. It was a heavily shorted stock, and when the stock rallied upwards, the short sellers were forced to buy the stocks at insane prices, and that resulted in a short squeeze which caused the price of GameStop to move even higher. It is also worth noting that not all stocks can be shorted. This is because when we short the stock, we will have to borrow the shares from our broker and then sell the shares. However, there may be instances where some stocks just can't be shorted because the broker does not have enough shares to lend to the people who want to short them. A put option is therefore useful in such a situation because you can profit from the decline of a non-shortable stock. Another advantage of buying puts is to hedge a position. Let's say you either own shares of a company or perhaps some call leads options and earnings are coming up soon. You may be long-term bullish, but the thing about earnings is it can go both ways and the stock could plunge. I mean, you just take a look at Facebook. Its stock plunged more than 20% after earnings. An investor who is long Facebook shares or call leads could have bought some short-dated put options as a hedge. And should the worst case scenario happen, the gains from his put position could help offset the losses from his long-term investments. Now that I've covered the advantages, let me talk about the disadvantages of buying a put option. In a highly volatile market, puts can be very expensive. This would mean that the stock will have to drop a lot before the put option can break even, let alone profit. Another disadvantage is that put options have an expiration date. This means that time decay will eat into its value, and if the trade goes against you and you run out of time, then you risk losing all the premiums that you have paid for this option. But as I mentioned earlier, if we were to contrast this with shorting a stock, then this really does not seem as a disadvantage, at least to me, since the maximum one can lose from a put option is the option premium, hence capping our losses. I would now want to share a strategy that you can use to stack the odds in your favor when you trade puts. However, I just want to give a disclaimer again. I seldom trade puts because I honestly feel that the market tends to have a upward biasness, and I personally feel that there is a lot of time and effort required to trade puts as compared to buying calls. But I would like to share this strategy nonetheless to help those who want to profit in a downtrending market. In order to execute this strategy, I will rely on my technical screener, Market Club. So for those of you who are new to my channel, just some introduction. I have a day job and I'm also a father of 3 kids. Plus, not to mention, I have 4 hands to take care of and a dog that keeps biting on my furniture each time the car horns. Hence, I do not really have the time and energy to screen for stocks as compared to when I was fresh out of university and I could trade till till 5 a.m. and wake up at 7 a.m. to work. Therefore, I rely heavily on Market Club to help me find bullish and bearish trades. This is how I personally use Market Club to find bearish option trades. At the homepage, click the top option tab. You will then be brought to this page over here. Now click the score button to separate the bullish and bearish trades. And what do you know? A quick and easy way to get a whole list of bearish plays. In order to place the odds in my favor, I will only consider buying a put if the overall market is giving me a negative score. The overall market over here refers to the Dow Jones Industrial Average, the Nasdaq Composite and the S&P 500. Next, I will evaluate the trend of the stock, and I will only consider stocks of between negative 90 to a negative 100. Next, I will use a fundamental screener just to check the fair value of the stock that I want to buy put options on. In my case, that would be Morningstar. So I will enter my Morningstar premium account and key in my stock ticker symbol over here. I will immediately be brought to this page where I can see the fair value of the stock that I have shortlisted, and I would normally consider trades on stocks that are trading more than the current fair value given by Morningstar. So I'm sure you guys can see that what I'm looking for is some stocks that are overvalued. However, I would like to give a word of caution. I personally feel that it's always good to take profits early, especially with puts. This is because when the stock drops a lot, you risk a relief rally, and that can cause your puts to lose their value extremely fast. Therefore, I tend not to trade puts as there's only so much excitement that my heart can take. Do type in the comments below if you guys want a more detailed explanation on Market Club. And if you guys are keen to explore Market Club, I also have an affiliate link down in the description below where I receive compensation for each sign up at no extra cost to you, and all sign-ups help keep this channel running. So currently Market Club has this ongoing promotion where it will just cost you $1 to try the service for 30 days. Okay, I would like to share some trade reflections and how I could have softened the blow of a recent losing trade with put options. I sincerely hope that with this sharing, you guys can learn how to use puts to hedge your position. So I was long Facebook via a leaps call, and my first mistake was not sticking to my trading plan. For whatever reason, I was too lazy to do a stop. I think during that period of time, Netflix was showing Money Heist and it kind of distracted me. Okay, sorry, I'm just finding excuses to make myself feel better. So when I bought Facebook, I was given the buy signal for Market Club, and I used my fundamental screener Morningstar and found that Facebook was way below its fair value of $400. Hence, I went ahead and bought the stock. Soon, the stock went up and my leaps were close to 100% profit at one point. My first mistake was not to use a stop to protect my profits. You have to understand that during that point in time, I had made a series of winning trades via leaps, and my confidence during that time was sky high. In my mind, this stock was only going higher. At the same time, I was so busy with work, and hence I was not actively tracking the market. When I noticed a weekly red triangle from Market Club, I hesitated in placing a stop as the bulk of my profits were gone, and I did not want to clock in a losing trade for the year 2021. Hence, I avoided the signal. So long story short, Facebook announced earnings a few days ago and the stock tanked. Before earnings, I did contemplate buying a put as a hedge. However, I wanted to save that few $100, and now my call position is down close to 90%. If I had stuck to the plan and bought a short-term put right before earnings, my position would not have been affected so badly. Hence, this incident has taught me the importance of buying short-term puts as insurance before earnings, as honestly, you never know what to expect. Okay guys, that's it for my sharing on puts. I hope you found value in it. I've also created a detailed video on the pros and cons of call options. Do check that out as well. And if you have enjoyed this video, then please do me a favor, like and subscribe to this channel for more options related content. Peace.